Hi, everyone, and welcome to today's presentation brought to you by Natural Gas Intelligence and Yes Energy, Unpacking the Hype, a deep dive into the energy industry's lofty natural gas and electricity demand projections. Today, I'm joined by Director of Analytics at NGI, Dan Spangler, and Product Manager at Yes Energy, Alex Bennett. I'm Leticia Gonzalez, Managing Director of North American Natural Gas Pricing. A little bit about NGI. We are a price reporting agency and data provider. We have over 170 daily price indexes that we publish, along with more than 80 forward curves. And so some of those prices you'll be hearing us talk about in today's presentation. And of course, we'll be drawing upon our expert natural gas market coverage and LNG data as well. Before we begin, I want to turn it over to Alex Bennett at Yes Energy to talk a little bit about Yes.
Yeah, at Yes Energy, we're a platform that energy market participants rely on to get through the daily crunch. So we're an end-to-end solution for our industry. We're providing valuable market data, forecasting, modeling, and trade execution solutions covering all aspects of the industry. So what does that market data look like? We're joining together a ton of different sources. We've got public power market data that's reported by the ISOs, other public sources like NRC and EIA, proprietary data sets like live power and demand forecasts, and rounding it out with partner data, which is where NGI comes into the picture. So for the last 3 years, NGI and Yes Energy have been partnered up, and this has allowed mutual customers on the Yes Energy platform access to NGI daily gas price index data, and this data flows alongside all other data that you use throughout all of our products. I'll hand it back to Letty to talk about the agenda, and we'll get into the webinar.
Thanks, Alex. So yes, just a side note, some housekeeping. We do want to leave, we have a lot of content to go over, but we do want to leave ample time for Q&A. So I encourage you all to drop any questions that you have into that chat box that should be on the lower right-hand pane of your screen. But today I'm going to start off by talking a little bit about the summer. Where are natural gas prices now and how did we get here? And then taking a quick look at where supply is now and how well supplied we are for the upcoming winter season. From here, I will turn it over to Dan to talk about our forward curves. He will specifically focus, of course, on the benchmark Henry Hub, but then also taking a regional focus and looking at some of those markets where we're hearing about data center development. Finally, he'll segue nicely into gas power burns for 2025, and then turn it over to Alex, who will take us through power demand growth drivers and some of the operational uncertainty that lies within the electricity market, as well as the changing generation mix. So to paint the picture for today's presentation, I chose a few key locations across the US, across North America, actually. And as I mentioned, these are part of NGI's data suite. So if you are not already a subscriber to our daily data, I do encourage you to click on the QR code and sign up for a trial. Starting with Henry Hub, that of course is the benchmark, as I mentioned. That's represented by the dark blue line here. You see that prices really aren't too far off where they are a year ago. We were at about $2.40 or so last year, and then we're about 50 cents. And then about 50 cents higher today. And so we have seen, though, a lot of fluctuation in that time. We saw prices escalate all the way to more than $10 in the winter time. But even before that, we saw in November, at the beginning of winter, we saw them hit a low of $1.23. So quite a bit of fluctuation just in Henry Hub. Taking a look at the yellow line is Carthage. That's one of the key price locations that we look at for Haynesville production. That generally tracks the Henry Hub. There's a little bit more seasonality to it, so prices can come in a little bit lower than Henry Hub, but generally the same trend line that you're seeing there. Moving on to the turquoise line is Nova Eco. Now, prices there are in Canadian dollars per gigajoule, but you see quite a bit lower than the rest of the US, or at least most of the US. And that's in spite of LNG Canada finally coming online in June of this year. Now, that is, of course, in direct response to all of the output that producers ramped up ahead of that facility coming online. And then, of course, continuing to churn out strong volumes of natural gas into that market. So that's really what's keeping prices there low. Now turning over to Texas Eastern M230 receipt. This is actually a location that's growing quite a bit in popularity. This is one of the key benchmarks for Appalachian production. And this location in particular is one that EQT Corp takes a look at and monitors closely to determine whether they're going to bring production back into the market or whether they're going to curtail production. And so for those of you that are curious, that key threshold is $1.50. And so if you look at the end of this curve here at the far right, you see that prices are not too far above that level today at about $1.67. So I should note though that we did see even lower prices at the end of August. So prices there did hit $1.25, but then increased here a little bit more. So that's definitely one of the locations that we at NGI will be keeping an eye on in the coming days and weeks as we enter the shoulder season. Finally, looking at the red line Waha, no surprises there. We're still seeing negative pricing, and this pricing behavior goes back 6 years. It's really just a story of too much supply, not enough takeaway capacity. Now that's not to say that we haven't had new pipelines enter service. We've had several, and in fact, most recently, Matterhorn Express came online. We also had a couple of expansions on Permian Highway and Gulf Coast Express. But as you can see here with the negative pricing that we've experienced this month, especially as we're entering the shoulder season, that the negative pricing is still very much in play. Of course, you know that a lot of pipelines tend to go under maintenance during the shoulder season. And so that's exactly what you saw here in September with Gulf Coast Express restricting some gas flows out of that basin and really crushing prices. Now, I mentioned that gas prices were still below $3. And again, that's Henry Hub. And so if you listen to this webinar a year ago, we did say that there was some upside in the forward curve, but not a considerable amount. And that is largely because of the producer response that we've seen. We did see the higher prices, those double-digit prices in the middle of winter at Henry Hub, and producers responded to that, bringing supply into the market and sending output to about 107 BCF per day. Now, what's different about this year compared to last year is that producers continued to push out the strong volumes even as we got into the shoulder season, the spring season. And so drawing your attention to the chart on the left, again, we have that Texas Eastern M230 receipt location, and this is Appalachian production. So we saw Appalachian production hit close to record levels at 37 BCF per day. We're still sitting quite, only about a half BCF per day back of that level here today in even September. And then on the chart on the right, no surprises there with the Permian Basin. Of course, we're still continuing to churn out supply there. We hit above 28 BCF per day earlier in the year. Now we have come back off of that. We're a little bit below 27 BCF per day, but as I mentioned, some of that production coming offline could be tied also to the pipelines that are undergoing maintenance. I should note too, there's been a little bit of market noise about whether production out of the Permian will continue to grow. As you know, the production that's coming out of that basin is associated gas. So the activity there is largely tied to the price of crude oil. But if you look at the West Texas Intermediate crude forward curve, prices are still above $60 throughout the curve. And so what this tells me is that the market, so far at least, is not overly concerned with the added crude supply that OPEC is bringing into the market. And so we do expect to still see the Permian produce natural gas, maybe just not at the lofty levels that it has here in recent years. Now moving on to the Haynesville, this basin needed its own slide because this is really where we expect to see the biggest growth come into play. In the Haynesville, of course, a lot of this production is targeted for those LNG exports. I know my colleague Dan is going to get into that a little bit more, but same story here as in the Permian. You've got a lot of pipelines coming into play. This is where we've seen rig activity increase. We've got 41 working rigs as of last week, and that's based on Enverus data. Now, this is up 17% year over year. Not a lot of production coming into the market yet. We are seeing an increase in the number of drilled but uncompleted wells there. But this is really the next biggest growth story as far as production is concerned. A lot of new pipelines coming into play. Most recently, we had new generation gas gathering that started up. We've also had Louisiana Energy Access that started up this summer. And then we've got some other expansions that are coming online here in the first quarter of 2026. So this is really where we see the next biggest growth occurring is in the Haynesville. But what about today's supply? Do we have enough storage and supply to get us through the winter season? Now, I want to remind you that last winter we withdrew quite a bit out of natural gas in the winter season at almost 2 TCF. But looking at the latest storage report, and this is based on last week's EIA data, we are at 3.43 TCF already, with still about 4 or 5 weeks to go in the injection season. And so this puts us on pace to hit over 3.95 TCF by the end of October. So very comfortable levels that we're looking at ahead of the winter season. But what about the actual winter weather? This is obviously still very early for these winter projections, but I will note that this chart was updated from NOAA just last week. And when I looked at this chart a month ago, or at this map a month ago, there was no change. So that's actually good to see that the projections that they're expecting haven't really shifted a whole lot. We are looking at a warmer than normal southern tier of the United States, and a cooler than normal Pacific Northwest and Alaska. I also want to note that the Pacific Northwest is expected to see above average precipitation. And the reason I want to mention that is because, of course, the more rain you have, the better the hydroelectricity generation will be in the spring and summer months, which could, of course, impact natural gas. Taking a look at the right-hand side of the chart, the Northeast markets all along the Southeast expected to be, as of now, warmer than normal. So this is something we'll be keeping an eye on, for all the talk about LNG and now data centers. It's really the winter season that continues to make or break this market. You get a warm winter and you don't withdraw down supplies. You start seeing those lower prices, which of course could cause producers to curtail their production. And then, of course, on the flip side, you get a really cold winter and the opposite happens. You take a lot out of gas storage levels, bring those down, sends a stronger price signal to producers to ramp up production, or at least to bring it online into the market and keep it online for a bit longer. So with that, I'd like to turn it over to my colleague, Dan Spangler, Director of Analytics at NGI.
Hey, Letty, thank you for that introduction, and thanks for setting us up where we've been over the past year in gas markets. I want to look at where we are going forward through the lens of NGI's forward curves. So to start out, I want to look at Henry Hub and NYMEX, looking at the forward curve at 3 different points over the past year. That light blue line is right at the start of winter. The medium blue line is at the end of winter, and then the black line is where we're at today. So there were several bullish and bearish factors that have hit over the past year that have really swung the curve up and then now back down. So that first one was a colder than expected winter in 2024 and 2025. As Letty mentioned, we went in with a bit of a production glut for natural gas. Storage filled early. We saw both cash prices and futures prices depressed at the beginning of winter. And the expectation was for a relatively mild winter. And then those price spikes that Letty highlighted in January and February, especially drew down stocks. Those cold snaps added to a winter that was maybe about average, a little bit colder than average. But that late season cold really drew down inventories and in turn drove up prices. Since then, we've seen more bearish factors come into play as we've seen the forward curve drop back down from those early summer season highs that we saw. That's partially due to production keeping up with demand, leading to storage filling a little bit faster than the market was expecting. And then also, which we'll get into a little bit more later, some changes in the power stack and maybe lower gas burns than what the market was expecting. All of this, it's important to note, there's a theme as we grow demand and supply rises to meet it. The storage capacity in the US has stayed relatively static over the past few decades. And storage really acts as that buffer on both a daily and a seasonal basis to soak up those price swings. And so as we see supply and demand increase and storage staying static, we get more susceptible to the sort of volatility like we saw last winter. So you can't talk about gas markets without getting into LNG. I want to focus a little bit more on power and data centers for this presentation, but it's still worth noting that LNG growth is by far the biggest contributor to growth of natural gas in the US. And so highlighted some of the existing facilities here in North America, US, Mexico, and Canada, and then the facilities that are coming up fairly soon here that are under construction, adding a significant amount of export capacity. And economics are still very in favor of exporting as much gas out of the US as we can to take advantage of those spreads between US prices and Europe and Asia. And so NGI publishes a lot of data on NGI that we can get more into the details, but just wanted to note that despite this being mostly focused on power and power growth, LNG is still the biggest driver of growth in the US. To look a little bit more granularly at some of the hubs that NGI publishes in our forward curve product, I tried to focus these on areas where we're either seeing data center demand growth or we're seeing existing data centers or are relevant to getting supply to those new regions. And so that first one I want to talk about that we have dropped there in Virginia in the green line is Transco Zone 5. So that covers an area from like the Georgia border up through Virginia. Virginia, of course, is a major area for existing data centers and also data center growth. You can see that gas prices there are relatively high compared to the other hubs that I have highlighted here. You have that seasonality in winter where prices can get quite expensive there. Contrast that with a hub like Waha there in West Texas and in yellow, as Letty mentioned, we see in cash and forwards all the time that hub drop into negatives. Again, as Letty mentioned, it's primarily driven by oil economics rather than gas. And so as it gets constrained, we see prices dip down. But one thing to note there is despite being very low right now, you can see as the forward curve progresses out a few years, it starts to normalize. Prices come up a bit. That's due to the significant number of infrastructure projects that are being built to get that capacity out of Texas. And it's a relatively friendly environment for building pipelines, which in contrast to an area like Eastern Gas South there in purple and Ohio and Pennsylvania is very difficult to build pipelines. And so that area is constrained, has been constrained for a while. And as the forward curve is suggesting, there's not a lot of hope for that to like fully deconstrain anytime here soon. But there is some data center demand growth in there. And so if some of those exist in the constrained area, they could soak up some of that demand that otherwise couldn't get out. The other two hubs there are more focused on areas where we see existing data center demand. So around the Chicago area there in green, and then around the blue dot there, that's gas flowing into California from the west. California has a bit of a unique profile where we see in that forward curve there 2 different spikes seasonally. Prices will go up in the winter, but they also go up in the summer to meet cooling demand. That dot also serves as a indicator for prices in the desert Southwest, where we are seeing a lot of data center growth. And noting that massive spread between Waha and SoCal border, despite it being relatively close geographically, again, just due to those major constraints, both getting gas into California and getting gas out of Waha. So this chart is pulled from a tool that we have on our website where you can look at individual contracts and see how they've traded throughout history. And so this is highlighting some of the extreme volatility that we see at these regional hubs. Waha there is very obvious. SoCal border and Eastern Gas South are both volatile hubs, and we see a lot of price swings. But Waha obviously is far and away the most volatile that we have highlighted here. That can be driven by a number of factors. So that March rise that we saw there, that was partially due to changes in NYMEX, with NYMEX prices coming down. These are all basis prices, so it's relative to the Henry Hub benchmark. So if Waha stays the same and we see NYMEX come down, the Waha basis goes up. We also saw, going back to Letty's chart, some negative prices there around that same time, which always gets the market concerned about what's going on with Waha and can lead to more volatility one way or the other. Contrast that with the more recent drop that we saw. That was also due to prices going negative in cash, but was primarily driven by maintenance events that were announced that are affecting gas getting out of Waha. Particularly one on Permian Highway, which takes gas out of the Permian and moves it east towards Houston Ship Channel. They have a 1 BCF plus reduction that's going to last for a couple of weeks in October. And so since that region is so constrained, that's going to just exacerbate it, and prices we see dropping down very low there. So looking at some of the infrastructure that I mentioned that is going to both alleviate some of the production constraints out of Waha and also feed some new data center demand. That first one on the left, a recent announcement by Energy Transfer, is a Transwestern expansion. So that'll move gas from Waha out to like the Phoenix area and then up north, more supply into California. That'll be an additional 1.5 BCF a day and has a Q4 2029 target and service date. That one on the right is a greenfield project by Tallgrass that is taking gas from the Permian up to REC Zone 2, which I have highlighted on that map there. That's up to 2.4 BCF a day and has a late 2028 target and service date. That pipeline will, one, deconstrain Waha. It'll change the dynamics quite a bit for what's flowing on RECs right now, which mostly is a full pipeline. And so if cheap Permian gas flows in there, it'll need to displace something else. But it'll also serve to feed new data center demand, where we've seen announcements around like Wyoming and the Cheyenne hub, where new data centers are being built there. So some of that gas will ideally supply that area. This is looking at the forward curve for the hub that's closest to that Rockies region that I mentioned, so Northwest Rockies. I wanted to highlight why it's important to look at both the basis prices and the fixed prices when you're looking at forward curves or daily gas. And that's because if you look at that one on the left that's just looking at basis, you see the March price there in light blue and August in dark blue. If you only looked at that chart, you might think that the Northwest Rockies price had rallied and that the curve had gone up. But again, like Waha in that October chart that we had, a lot of that was just due to changes with NYMEX. And if you look at the fixed, so the absolute price at the Northwest Rockies hub, we actually saw the forward curve, at least in the first few months there, come down and then it stays relatively steady before dropping down further in the curve. So it's important not just to look at these regional hubs to get that better granularity rather than just relying on Henry Hub and NYMEX, but also looking at both basis and fixed because they can paint a different picture. And so you kind of have to take them both into account. And so the last thing that I wanted to mention, at the beginning, I talked about power burns and how natural gas power burns were down this year. And that was one of the contributing factors to storage filling a little bit faster than the market, I think, was expecting this year. There are a few reasons for that. It's important to note that while total generation in the US is up, natural gas contributions to the generation is actually down. And so there's a few reasons for that. One is those higher gas prices that we saw at the beginning of injection season was leading to coal to gas switching, coal prices being relatively cheap, coal stocks being high. We saw coal eat into some of the thermal stack share, which was knocking out natural gas. But that could be temporary. If we see natural gas prices come down, then that will swing back the other direction. And that's actually what we've seen so far here in September. The coal to gas ratio for the generation stack is about what it was last year, whereas solar is a much more structural growth. So as we've seen capacity grow in solar, we've seen that contribution to the generation stack increase by quite a bit. And despite not being nearly as big as natural gas's contributions, it is cutting into what was normally burned by natural gas. And we'll continue to see that solar growth. And next year, we'll continue to see that be a major impact for limiting natural gas for power generation. Got a couple of QR codes here for the prices that Letty and I both highlighted for the natural gas side of things. And with that, I'll kick it over to Alex to talk a little bit more about power.
Thank you, Dan. And yeah, as a quick introduction, I'm Alex Bennett. First and foremost, I am a power market enthusiast. And then second, product manager here at Yes Energy. I'm going to work through these slides pretty quickly for the next 15 minutes, but make sure to ask plenty of questions because we're going to have time at the end to answer them. And here, wanted to set the stage and stealing some slides from our CEO. This is regarding electric demand during his career in the industry. On the screen is electric demand from 99 to 2025. Growth relatively flat. Now, whenever we zoom out, this picture changes significantly. The red circle is the career that we were just looking at. Things have been extremely flat, but now looking forward, there is a load growth era being projected. And I'd mainly like to call attention to the purple data center category. This is one of the larger drivers of this growth projection. But the main takeaway here, load growth is the biggest topic in the industry right now. How are we going to meet this growth? Will these projections materialize? How will the new load operate? And that's created a lot of uncertainty. And one thing that is certain is that demand is now an increasing part of the market equation for power market participants. And I'm going to start by looking at demand, and then we're going to flip over to the generation stack and how it is changing to meet this demand and also creating some interesting dynamics. So we'll start with data centers. And at Yes Energy, we do track infrastructure changes on the grid. This is generation, transmission, and load centers. And we're tracking from the conceptual stage all the way through operational start. On the screen is data center build out from 2018 to 2024 and under construction projects looking forward. Operating capacity in green, capacity additions light green, under construction projects in yellow. From 2018 to 2024, we saw data center load triple, going from 12.4 to 36.2 gigs. This is important to point out that this is contracted power at these facilities. Not all of their facilities do pull their contracted amount. They do like to have some headroom. Looking forward through 2027, there's 20.5 gigs of cumulative projects under construction with a projected online date of 2027. And I focused in on under construction because much like generation interconnection queues, there's a lot of noise when it comes to facilities being proposed out into the future. So I really wanted to narrow it down to these are facilities that have broken ground and are projected to be online in the next 3 years. One of the main drivers behind this data center growth is crypto mining facilities. These are a new style of large flexible load connecting to the grid. They're price responsive. They show a lot of operational variance. The chart on the screen, exact same format as last time or last slide. And in 2022 is really whenever crypto busted onto the scene. And from 2021 to 2023, crypto also effectively tripled, going from 2.5 to 7.1 gigs. Another note here, half of this capacity is currently connected in ERCOT. They got 3.6 gigs of crypto mines. And looking forward, there is 7.7 gigs of capacity under construction with a projected online date of 2027. That's another doubling of crypto capacity on the grid. With this new load connecting, how this load operates is a big question mark. And up on the screen is a quick example of two different styles of data centers and their load profiles. On the left is a traditional style data center. This is Google's Midlothian Sharka data center. It's hourly load for all of 2024. And you can see that this facility is steady Eddie. We don't see a lot of variation in output or load that it's drawing from the grid. On the right, this is contrasted with a crypto mine. This is Core Scientific Denton Data Center. Can't do hourly load for the whole year. This is instead a 6-day period from the summer. And this crypto mine is turning off 5 out of 6 days, and it can respond extremely quick to price and market signals. Now, data on these load centers is hard to come by. And in ERCOT, you've got a 60-day delayed view transmission. So the previous slides that we were looking at is using ERCOT state estimator data. Outside of ERCOT and other markets, you've got some snapshots, maybe 1 to 4 a day through state estimator. But in general, insight into load center operations is limited. This graph on the screen is a hypothetical scenario. You're an ERCOT trader. You're interested in Riot Rockdale crypto load, but you're 60 days lagged. You want to know what the facility is doing in real time. This is where live power data comes in to fill the gap. For those that don't know, live power is Yes Energy's physical sensor-based grid monitoring solution, and it provides 60-second updates on grid flows. So we are monitoring load centers, and this is letting you know when facilities connect, what level these facilities operate at. And for markets outside of ERCOT, this is potentially the only data source available to get this style of information. That's the case here in New York ISO. This is TeraWolf Crypto Mine, and this may be the first time this data is being presented publicly. Here you can see the load profile for the facility over the summer as July through August. In July, there's plenty of variation over the summer before more stable load by the end. And the facility did start to show decreasing power levels. If you're interested to know and how the facility is operating right now, you should reach out to me after the webinar and we can start a discussion. Now, data centers aren't the only coverage that live power provides, and this is where we've got overlap with the natural gas industry. We do track LNG facility output in real time. Right now, that coverage is just Freeport LNG, but we are growing it out. And this has been a facility that has seen a lot of operational variance in its 5-year history. Graph on the left is live power weekly load for the facility. And for 5 times, you can see that it's shut off it's shut off 5 times over the last 5 years for extended periods. Graph on the right, this is the most recent shut off that we saw that was extended. The facility turned off during a cold snap in Texas. Live Power was the first to provide an update as to when it shut off and also first indications of when the facility was ramping back online. To close out this section, Live Power has load center coverage available across 5 ISOs. We'd love to hear what you'd like to see monitored next. Please get in contact with me after the webinar. So it's a really quick view of kind of demand. And now we're going to shift over to the generation stack and how it's rapidly changing to meet new load. On the screen, this is EIA 860 monthly data. And this is capacity growth by technology from 2020 through today. And the biggest thing to point out here, solar orange at the bottom, is the largest generation capacity addition that's happening around the United States. It represents 44% of the 223 gigs that have been built in the last 5 years, leads the way by a country mile. And another thing to call attention to, ERCOT is blowing everyone out of the water. They've added 50.7 gigs of capacity over the last 5 years. This is no surprise, and they are blazing the way on solar build out. This is just the tip of the iceberg when it comes to capacity additions. Now this is the same format of chart, but we're looking at planned capacity additions, and ERCOT has 77.1 gigs of capacity planned to be built out by 2030. The largest lion's share of that is solar, followed by batteries in red. And batteries are a interesting dynamic that is coming onto the grid, specifically in CAISO and ERCOT right now. I will talk about that in a couple of slides. And one other interesting call out on here is that WEC is the second largest region that's seeing planned capacity additions. This is also an area that has 2 markets that are going to be coming online in the next couple of years. Another view of how fast solar is coming online in ERCOT. This is the daily average solar hour. So peak solar hour for each day, average for the month. And so in August 2020, on the left side of the graph, ERCOT was getting 3.5 gigs of solar. This past year, August 2025, they were getting 25.3 gigs of solar generation in the peak hour. Now, with all that solar rolling on the grid in ERCOT, something has to ramp down in its place. That's our thermal fleet. And really, we're seeing more frequent daily cycling. And so this is an example from ERCOT again, using their 60-day SCED gen resource data. And I've compiled yearly combined cycle and coal data and split it out to the generation profile. So 2019 generation in the dashed lines and last 12 months in the solid line. On the left, our combined cycle in 2019, starting around hour ending 5, it was starting to ramp up throughout the whole day to the demand peak around hour ending 17 before tailing off. Now our solid LTM, which is last 12 months, the generation profile has changed significantly. There's a morning ramp, and then it starts to ramp down in the middle of the day as solar comes online. And then an interesting call out at the end of the day, we're seeing a higher peak. And also we are seeing a steeper ramp rate up to that peak as solar rolls off of the grid. On the right for coal's straight up just getting left behind with all the solar additions. There's many factors outside of just solar that are contributing to this, including retirements, but they are showing a similar, coal is showing a similar kind of shape that combined cycle is, but it is just at a generally lower level than it was in 2019. Whenever solar rolls off of the grid and we see increasing solar, it is causing faster ramp rates. This is another way to visualize renewable production load and net load on the left. This example is from CAISO. Green is our renewable production. Blue is the net load. This is load net of renewables. Black is load. In the middle of the day in California, we see a massive divergence between load and net load. Load's sitting around 30 gigs. And then in the middle of the day, we've got 10 gigs of net load. Whenever the sun sets around hour ending 18 to 21, we see a really steep climb on this net load. This is pushing ramp rates on thermal resources. It's creating a lot of interesting price dynamics, but this is where batteries actually enter the picture. On the right, this is CAISO's hourly summer, July, and August battery gen. And in hour ending 20, batteries are ramping up to 8.6 gigs. It is smoothing out the curve. This next chart is another way to look at this. This is a 1 hour ramp rate, and the dark blue is net load. And then light blue is a new category I created, net load less battery discharge. And over the last 5 years, there's been a pretty big divergence. Net load is ramping 6.5 gigs in the peak hour of solar rolling off the grid. But the light blue, net load less battery discharge, batteries are keeping thermal ramp rates flat over the last 5 years. Now, ERCOT also has exploding battery capacity. Chart on the left is showing over the last 5 years that ERCOT has pretty much added 17.6 gigs of battery capacity. Graph on the right is the SCED resource report. This is showing what is actually showing up in SCED. And there's about 10 gigs of that 17 that is in SCED at the end of July 2025 or June 2025, with the majority of that being real-time energy offers to SCED. And kind of round this out, ERCOT historically has had some very expensive battery offers. And this chart on the screen is splitting out the last 3 to 4 years of battery offers in SCED, averaging it for the month and splitting it out by offer level. Dark red is going to be above 4,500, and then green is going to be below 200. For the last 2 to 3 years, batteries have been relatively expensive in ERCOT, but this new capacity has pushed battery offers a lot more cheap to the system. And so as of June 2025, there's over 4 gigs of battery capacity that is less than $200 available to SCED on average. This has caused a very big price suppression in ERCOT as compared to 2023, whenever the stack was getting into batteries that were at 4,500 offer level and pushing heat rates and prices through the roof. With that, I will move us on to the Q&A.
Awesome. Well, thank you, Alex, for that presentation. So we'll go ahead and start with you then in the Q&A. I do have one here. Do you have any data on hyperscale data centers?
So I actually met with somebody a couple of weeks ago about this, and there's a couple of different sources in order to get this information. You could look at state estimator data. In ERCOT, you could look at the 60-day delayed state estimator data. But right now, where the hyperscale data centers are being built that are at least online, none have come online in markets that have data available. And so at Live Power, we are targeting some of these facilities. And one of the ones specifically that we are going after is the Stargate data center outside of Abilene. OpenAI is making a big investment in that facility. It's still being built, and we're still trying to figure out how it connects to the grid. So right now, no, I don't have any data, but we are working towards getting this data available.
Great.
So Letty, I've got a question for you. With the storage inventories so full, is there a chance that producers could actually start to pull back production?
Yeah, so that was one of the things that I mentioned in my presentation. For example, just in Appalachia, EQT, looking at that Texas Eastern M230 receipt location. What I will say about producers these days is that they are far more efficient than they were just a few years ago. So they're looking at those cash prices in the market and that $1.50 trigger is when they could start to curtail production. I would say that that's something they're looking at. They can ramp up and take down production almost on a daily basis these days. So that just shows you how much efficiency they've brought into the market. So it's still hot here in Texas. And so it's still kind of summer going on. We don't have super low prices just yet. I expect there to be, lower prices here in the coming weeks as demand falls off a little bit. So that's something we are going to be watching. Now, I will say that just like this year, I don't expect producers to really take off a whole lot of production. There's going to be pipeline maintenance that's going on that could restrict some flows, some field maintenance events. But by and large, the demand is coming for natural gas. We've got these LNG facilities that are continuing to ramp up. And so they want to make sure that that production is there to meet the needs of these facilities. So by and large, I don't expect to see a large pullback in production. We're going to see some fluctuation, some seasonality, but generally speaking, I think the producers are going to be there and waiting for these new facilities to pop up. And then, of course, the winter demand that hopefully will come this year. Let's see. I think we could take another one. Dan, in the forward curves, we've seen projections pretty wide for data centers. And so I think there's a little bit of consensus now around 4 to 8 or so BCF per day coming into the market. So how does data center growth impact those forward curves that you mentioned?
Yeah, it really depends on the individual hub. So any new data center demand that's going to be fed by gas will obviously be bullish for that hub. In an area like Eastern Gas South that's primarily producing and is constrained, if there's new demand within that constraint zone, then that can alleviate prices a little bit. Similarly, if you're in more of a demand zone like Transco Zone 5, where we saw a bunch of data centers coming online in Virginia, those prices are higher, and any new demand could bring those up more. Obviously, the price of natural gas is a factor that data center site selectors would look at, but it might not be the primary factor. And so even if there's an area that's more expensive like Virginia, if it has good access to water, land, fiber, like whatever else data center providers are looking at, then price might not be the biggest factor, but it could bring up prices for everyone else if there's significant new demand there. And we do see natural gas being a major contributor, especially in the short term here, for powering these data centers. I see another question in the chat for me and Letty, talking about if LNG is a big driving force for the 2030s, why do we see the forwards falling compared to 2025 and 2026? That is a good question. So LNG, especially as you go further out the curve, there's more risk baked into it, and those forward curves become less of a good indicator and really like a price forecast. And it's really just what the market is using those hubs as, and it can be like for hedging. And so it's not necessarily that prices are going to end up where the forward curve is. That's a risk weighted market indicator. But I think the fact that the curve is a bit backwardated, it's really showing to the confidence and the strength of producers being able to meet that demand for LNG. So Letty was talking about the Haynesville and the Permian. We see those. There's a lot of extra resources there. There's a lot of infrastructure coming online, where each of those producing regions can get that gas down into the Gulf. And we see there's a lot of resource in the Haynesville that's just waiting for that price signal to be able to start producing. And so it could really ramp up depending on what prices do. And so if we see LNG start to sway things in the other direction, the fact that the forward curves aren't spiking a crazy amount really just shows that confidence that producers will be able to meet that demand, as they sort of always had, since we've seen demand spike here in the US over the past couple decades.
Yeah, I would agree. I mean, we've seen them respond this year and really keeping output strong, even as prices did come off a little bit in the spring, and we could see prices come off a little bit here in the next couple of weeks before winter demand really starts ramping up. But by and large, the structural growth is there on the LNG side. And even if we get a fraction of the data center demand that's being projected right now, that's also still a significant amount of demand that's coming into the natural gas market. And so these producers are ready to respond to that. Um, Dan, we've got one for, I mean, I'm sorry, not Dan, Alex. Is solar replacing coal and ERCOT, or is it really just meeting additional demand?
Yeah, this is an interesting question. I would say largely no. And what is actually around the United States, not just in ERCOT, what's replacing coal is gas. And so we've seen a lot of coal to gas switching taking place. The pricing dynamics of coal has gotten pretty complicated. There's a lot of regulations on coal now, environmental reasons and pressures, and specifically SOX and NOx credits that they have to obtain have gotten relatively expensive. And it has flipped the stack to the point where coal mostly sits above the majority of gas in the stack. And so that operational decrease as a result of that and lack of dispatches mean that a lot of coal is retiring. To bring it back to ERCOT specifically, they've had a couple of gigs of coal retire. Now we can't really retire the remaining facilities. And this is what a lot of the grids around the US are seeing, is that coal started to roll off over the last like 4 to 5 years. And now we are doing our best to keep those facilities online with this load growth that's coming. And so solar is really causing, I'd say, on-peak suppression, but then we're seeing a lot of off-peak increases as a result. Batteries are starting to charge overnight in ERCOT. So coal has got a very complicated dynamic around the US, and those retirements are a large portion of it. And then solar is kind of doing the midday downward pressure.
See another one here in the chat, back to gas. Let's see, can you provide an update on trends that we're seeing as related to Sumas, Washington, so the import point from Canada into the US?
Yeah. I can take that one. So, this is one where we're going to actually be keeping a close eye on this here as we get into the winter. With LNG Canada online now, we were wondering if we might see fewer imports into the United States from Canada now that that facility is online. And we did see a decrease like right after it came online, but it also happened to be like, in June when there's just not a lot of demand. And then it's fluctuated and it's really hasn't changed so much year over year. Now, that is something we're going to be watching this winter, though, because last winter, when we had that really cold January and February, at one point we imported more than 10 BCF per day from Canada. And so we're going to be keeping a close eye to look and see, how much gas we're going to continue to bring in when we need it. I can expect to see, maybe some reshuffling of flows a little bit to meet that demand. And so that's just one of the markets that we'll be keeping an eye on, because Sumas, I always consider Sumas kind of the Algonquin city gate of the Pacific Northwest. It's very volatile. We see a lot of really high prices in that market during the winter season. And if we see any pullback in imports from Canada there, then I can expect to see some volatility. But again, that goes back also to, but maybe not, because we've got, if it turns out to be a very rainy season in the Pacific Northwest, then maybe you'll have more hydro generation coming into play. So there's a lot of variables that we'll be watching that really drive that Sumas price, but we'll definitely be keeping an eye on it.
Yeah, and just to add to that, so there's plenty of production in Western Canada to supply the U.S., and it's really just about those constraints. And as Letty mentioned, we see Sumas blow out similar to like Algonquin City Gate, and that's not really due to a drop in production. That's just there's not enough capacity on the pipe. And so it comes down a little bit more to infrastructure and how they can get that production into the US, and then how much that LNG Canada either sits above or below where that constraint point is.
Alex, we've got one for you here. Explain why solar is still growing as a resource in Texas.
Yeah, interesting question. I think that really all participants that are on the development side of the business are going where the money is. And there's been, I think that there's a couple year lag in this. And so 2022, 2023 had extreme pricing dynamics. And so people are trying to go locate their resources to capture that price. And, the last couple of years, we've seen a little bit of a decrease in the pricing dynamics, mainly due to batteries. We're seeing them, the offers cool off. And so they're becoming a little bit less expensive whenever they get dispatched during the sundown peak. Another thing that we're seeing is kind of like there's a very interesting dynamic with kind of virtual PPA agreements where a company, some sort of entity outside of Texas is essentially building solar in Texas to offset their carbon. And so it's a contract that's guaranteeing money for this solar resource. And now solar gets built in Texas to say that they have generated, clean power. And so I think that's another dynamic that has helped to see solar come in. And with those load growth projections, I think that also is attracted solar to the market.
Right. We've got one talking about the winter. So and I can take this one. How does extreme winter weather in production regions affect production? This is definitely one that moves the market on a day-to-day basis. When we get those big winter storms, during Winter Storm Uri and all the other big winter storms, we see quite a big drop in production, sometimes upwards of 10 BCF per day, or even more significantly. And this, of course, drives a production. Now, not all of this production stays offline for, the entirety of the winter season. Once it goes offline, sometimes it could take days, but sometimes it could actually take weeks to recover, especially if you're talking about basins like in the Rockies, for example, where it's traditionally pretty cold and snowy. And so there's a lot of local conditions in place that really prevent that supply from coming back into the market. And so that's a lot of what drives this, volatility on a day-to-day basis. It's likely one of the reasons we saw Henry Hub prices get to over $10 in January. But, we also see prices recover pretty quickly once that production comes back into the market.
Yeah, and I would also add with that, those freeze-offs that we see typically hit at one of like the first cold snaps that we see in the season. Different areas of the country have different preparations that they'll put in place for either like insulating the wellhead or having crews go out there and fix it. And so as Letty mentioned, like it really is a big variable. In some areas, it can take a while to get out and get those fixed. I would say it's also important to note that we're still in hurricane season here. It's been relatively muted, but hurricanes were typically a production destruction event. They would come in and knock out production in the Gulf. But as production has gone down and LNG has ramped up and power has ramped up in Gulf states, it's really more of a demand destruction event. So that's also another thing to keep an eye on that could affect the market. If we have a big hurricane come in, it could depress prices if it blocks LNG exports.
Yep.
I think maybe as the last one, we've got a lot of good questions in here, but I know we're running a little bit short on time here. This one kind of hits all of us, talking about off-grid demand and off-grid support for data centers, specifically with natural gas, but also with renewables. And how much it makes sense and where we see that coming from. I guess, Letty, do you want to kick off gas, or Alex, do you want to talk about the renewables side?
I mean, yeah, I can start. Natural gas demand, they are getting these on-site solutions. So they're not actually connecting to the grid, but they're still using natural gas. And so I think that's still why one of the reasons why we don't have a firm grasp on exactly how much natural gas demand is expected to grow from these data centers, because a lot of it we just don't know. Some of it's not even connected to the grid. Now that said, I have heard that too, that of course, one of the reasons that they are going to natural gas is because it's reliable. We have vast amounts of natural gas here in the United States. It's cheap. As far as renewables are concerned, on a cost basis, I don't think it's anywhere in the same ballpark as natural gas, and especially for being a stable, round the clock resource of energy for these data centers.
On the power side of things, we've how is it affecting power markets? It's still being determined, and so these data centers connecting to the grid, but they've also got on-site generation solutions. When are they going to use on-site gas? When are they going to pull from the grid? What's that mix going to be? This is the same thing with LNG as well, and LNG facilities that connect to the grid. I'd say in the LNG world, there's a lot more facilities that are off grid and just use on-site gen, but the ones that do connect, there's a mix of when are they going to pull gas, when are they not. That's truly where the power market is affected, is that if there is a variation between that, specifically with data centers, if they're pulling from the grid mainly, and then they'll switch to backup gas, that will create interesting pricing dynamics. And so that is the big impact, is when are they pulling gas? When are they pulling from the grid?
Yeah,
Right.
absolutely. And that can definitely change as those data centers are built. If they have a behind the meter gas generator on there to primarily power the data center until they can get a more stable connection to the utility, or they can get a power plant connected to the grid, and then could potentially shift that gas generator over to backup power once they do get other options. So it is difficult to sort of track and forecast all of that, because if they're not connecting to the grid, then those projects don't show up in the interconnection queue, and so we just get less visibility, which makes it hard to figure out what's going to be powering these data centers and how much of an impact that's going to have on powering gas.
All right. Well, we do still have a lot of questions in the queue, but unfortunately, we are out of time. As I mentioned, though, we do have your emails, and so we will be looking at the questions, and we will be looking to respond to all of those here in the coming days. We want to thank you all for joining us today, and on behalf of Alex and Dan and myself, thank you all for joining us, and we hope to see you soon. Take care.